One question comes up all the time. I'm the only owner of my LLC. How should I pay myself? The answer surprises many business owners. In most cases, you generally don't put yourself on payroll. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS rules. Let's talk about why. In our last video, we learned that every business has a legal type and a tax type. Today, we are answering a practical question. How does the owner of a single member LLC actually pay themselves? If you're the only owner of your LLC, this video is for you. Here is the first thing to understand. You own the business. You are not an employee of that business. That's why you generally don't pay yourself through payroll. According to IRS guidance, a sole proprietor cannot be an employee of their own business. So if payroll isn't how you pay yourself, what is it? The answer is an owner's draw. An owner's draw simply means moving money from your business account to your personal account. That's really all an owner's draw is. You're moving money from the business to yourself personally. Think of your business bank account as the home for your business money. Payments from your home care clients should generally enter business account. Business expenses should generally be paid from that same account. This creates a clean financial system. Business income comes into the business account. Business expenses leave the business account. Then when you want personal money, you transfer funds from your business account to your personal account. Most banks and credit unions make this very easy through online banking. You can log in into your account, choose the transfer option, select your business account, select your personal account, enter the amount, and complete the transfer. You may also write yourself a check from the business account and deposit it into your personal account. Either method achieves the same result. The money moves from your business to you personally. In your accounting records, that transfer should generally be categorized as an owner's draw. It is not a payroll expense. It is also not a business expense. The business is simply distributing money to its owner. Now, let's clear up another common misunderstanding. An owner's draw is not the same as business profit. Those are two different financial concepts. Profit tells you how much your business actually earned. An owner's draw tells you how much money you choose to withdraw. Those amounts do not have to match. Imagine your home care agency earned $80,000 during the year. After considering your business expenses, your final profit is $80,000. You decide to withdraw $40,000 for your personal needs. You leave the remaining $40,000 inside the business. Maybe you're planning to hire another caregiver. Maybe you're preparing for a slower payment period. Maybe you're building an emergency reserve, or maybe you're saving for future growth. Your home care agency still earned $80,000. Leaving money inside the business does not reduce the profit. Your draw was $40,000. Your business profit was $80,000. That is the important distinction. Your draw is the money you withdraw. Your profit is the money the business actually earned. This also means you should not choose your draw by simply looking at the current bank account balance. Your business bank balance does not always represent money that is available for personal use. Some of that money may be needed for caregiver payroll. Some may be needed for payroll taxes. Some may be needed for insurance premiums. Some may be needed for upcoming business expenses. And some may be needed to remain as a cash reserve. Before taking an owner's draw, look beyond the current business bank balance. Consider your upcoming business obligations first. Then decide how much the business can safely distribute to you personally. You can take owner's draws regularly. For example, you might choose a weekly transfer, a twice monthly transfer, or a monthly transfer. You can also take draws only when the business has enough available cash. There is not one required schedule for every owner, but using a consistent schedule can make your personal finances easier to plan and manage. For example, you might choose to transfer a set amount twice each month. That can feel similar to receiving a regular paycheck, even though it's not payroll. The transfer remains an owner's draw. You are not issuing yourself a Form W-2. You are not withholding payroll taxes from that transfer. You are simply moving business money to your personal account. Another question I often hear is, can I ever put myself on payroll? If you're the only owner of your LLC, generally the answer is no. You are the owner, not your own employee. However, the answer can change if your business later chooses a different tax structure. For example, different rules may apply when a business is treated as an S corporation or a C corp. We will cover those situations later in this series. For today's lesson, remember the rule for a single member LLC. You generally pay yourself through owner's draws, not through payroll. Let's bring everything together with one simple picture. Your business account is the home for business activity. Client payments come into that account. Business expenses live from that account. When you need money personally, you transfer money to your personal account. That transfer is your owner's draw, and your owner's draw does not determine your business profit. If you remember only one thing from today's video, remember this. If you're the only owner of your LLC, you generally pay yourself through owner's draws, not through payroll. In our next video, we'll talk about businesses with more than one owner. You'll learn why partners follow different rules when paying themselves. I'll see you there.